Hello and welcome to Risk at Work, Risk Connect's educational web series. I'm Scott Fenstermaker. I'm the VP of Digital Marketing here at Risk Connect. Today we're going to be talking about navigating the digital risk cycle, strategies for business maturity. We sometimes think about certain areas of risk that we have to treat proactively, even though they're not necessarily an endemic part of our business. We still have to pay them attention. Geopolitical risk comes to mind as one of these ideas, but there are more of them. One of the ones that we definitely don't pay enough attention to are the risks posed by emergent technologies. We deal with these things every day, but we don't necessarily have the habit of thinking about it as a risk area on its own. And it presents risks to our businesses whether we decide to adopt these emerging technologies or not. They prove to be very difficult to simply sit out and say, I will not engage in this technology, therefore it doesn't affect me. One of the things that comes to mind when you start thinking about this risk area as a risk area is that emergent technologies tend to follow a certain pattern of societal adoption, a certain predictable pattern, which means that the risks associated with them and the velocity of those risks associated with them also tend to follow a certain predictable pattern, which means that we can always do a better job of thinking through the risks that emergent technology is going to pose to us and coming up with solutions and mitigations and strategies to be able to deal with them proactively. And I've got the perfect guest to be able to talk to us about this idea today. You're going to learn a lot. We have a brand new contributor to Risk at Work that I'm very excited to introduce. A couple of housekeeping points before we get there. Number one, if you have questions for our guests today, please put them in the question field of your webinar software. If the question is not answered as part of the presentation today, then we will get to you directly with an answer from our guest. Also, if you selected that you were interested in CPE credit for attending this webinar, watch your inbox after we are done today. You'll receive an email from us that contains a short quiz. Answer that, get it back to us. We will reply with your CPE credit. All right, very excited to introduce this gentleman for the first time joining us at Risk at Work. He is the founder and CEO of Wheelhouse Advisors, but you probably know him more from his work at Gartner, where he was the global research leader for risk management technology markets. He's a many-time top author at Gartner and a Thought Leadership Award winner. He has spanned many roles over the past few decades, spanning executive management, finance, risk management, audit, and IT. It's my distinct pleasure to welcome for the first time here, John Wheeler. John, how are you doing today?
Doing well, and thanks, Scott. I really appreciate that very nice introduction, and I'm so thrilled to be a contributor to the Risk at Work series. This is going to be a great journey, I think, for us, and I think this topic is a great one to start with. And I really appreciate you giving that context because this is a new area of um, not only research for a lot of folks in my realm, but also a new area for risk managers as they start to delve into these emerging technologies and their new uses. So that's what it's all about today. And I want to focus on three primary discussion topics, pretty straightforward. But my goal is, as I tell most of my audiences when I'm doing a webinar of this sort or speaking engagement, is always to provoke thought. And if I've provoked at least one new thought for our audience members today, that will equal success. And just to get folks to think about things in a slightly different way so that when they go back to their day-to-day jobs and activities, they can incorporate some of these new new views on the risk landscape into what they're doing. So with that in mind, what we'll do is first get a better understanding of what digital risk is. And I'll offer up a definition. It may or may not align with some of the folks on the call or not, but want to put that down as a foundation and then talk about integrated risk management as both an approach and set of technology that helps to manage digital risk as well as a variety of other risk topics. Then we'll get into what, Scott, what you were alluding to before, and that is how can organizations anticipate these new risks, new digital risks that are coming from the emerging technology arena? And we'll go through the 5 stages of the digital risk cycle and understand how folks can better prepare themselves and their organizations. And then finally, um, taking that view and giving you some concrete action items that you can use right away in your organization to prepare them for the ever increasing loads of digital risk that are piling up for everyone. So with that, let's get right into it. And the very first thing that I like to share with folks is kind of the magnitude of the risks that we're talking about. And for those on the call who are risk leaders, this won't be a surprise to you, but when you go to do a risk assessment, my bit of advice to anyone who's doing a risk assessment is to start with the money. Typically, if you follow the money, you're going to find the risk, or at least the higher levels of risk within an organization. And so, right now, and certainly since the beginning of this decade, digital investment in organizations is accelerating like none other. And the reason why is CEOs, their boards of directors are continuing to look for new avenues of growth. And one of the primary ways to grow the business today is through digital means. So, just to give you an example of what I'm talking about, I got a few data points to give you an idea of the scope, the size, and magnitude of this digital investment and how much money is actually going into this. First and foremost, this comes from this figure here, $3.4 trillion. This comes from one of my former competitors when I was at Gartner, IDC, and they put together an annual digital transformation spending guide. Currently, they are pegging $3.4 trillion as the amount of projected digital transformation investment in 2026. So in 2 short years, we're going to see that amount of money pouring into the digital environment. And coupled with that is the fact that what McKinsey has to offer here, the total annual economic benefits of generative AI, I view generative AI as one of the primary sources of great digital risk today, given all the hype around it, but also just the new use cases and new uses that it's creating in organizations. But the total economic benefits that McKinsey and Company pegs for digital, $7.9 trillion. And so when you take a step back and think about these numbers, in the trillions of dollars globally, digital is going to and is already reshaping how organizations are not only operating within their 4 walls, but working with others, third parties, vendors, suppliers, partners, and creating wholesale new products and services that customers are using in all sorts of different ways. And that just means one word: risk. So when you then start to peel the onion and think about digital and its very many uses, at the very core is the technology asset. And that technology asset has to be operating 100% for these digital products and services, new processes, the transformation that's ongoing to really, really work. And the quality of digital tech, as I say here, is truly suspect. Or as my daughter, who is in college now, but she always says, suspect means sus in today's terms. So digital tech is truly sus in the Gen Z terminology. And the reason why, I've got a few facts and figures for you, is number one, the technology itself, whether it be software, hardware, um, you name it is developing at such a rapid rate that it's hard to keep pace with the maintenance needs and the overall quality assurance needed to supply this sort of technology. In the software realm, we have here greater than $2.4 trillion dollars is what's estimated to be the total cost. And this was in 2022. So I'm sure it's even greater at this point stage, but the cost of poor quality software in the US alone is $2.4 trillion dollars. When you match that up against the figures that we are just seeing in terms of investment, that's really cutting into that potential benefit. And then when you add into that the fact that most of the software is riddled with all sorts of different components that may or may not be proprietary in nature to the organization or the developer in question. They may be relying on open source components that, when they are combined with the software technology being used, may have some unintended effects. And then on top of that, once these open source components are added in, there's a need to keep track of what technology is using. And many organizations aren't doing a great job of that. So here is some information from darkreading.com. And it's actually from a survey that was conducted at the end of 2022 that said 88% of code bases, software code bases, are using open source components that haven't been updated in the past 2 years. And while that may be fairly innocuous for a lot of the components that don't need to be updated necessarily, the problem is organizations don't really know. They lack the visibility into what's in there, what's not. So when something is impacted, like when you consider the Log4j um, um, problem that we experienced, gosh, it's been now over a year and a half. That Log4j was so prevalent and pervasive in code bases, it set off a scramble of organizations trying to figure out whether or not they're impacted by the potential vulnerability within that open source code base. So just the amount of time and effort and money spent simply to identify, even if they had that code in their software, in the products and services that they're delivering, was a huge amount of money. And then finally, when you layer on top of the fact that more and more of these technology components, whether they be open source or not, are now also highly integrated, and the use of application programming interfaces is off the charts. And recently in the Wall Street Journal, it was reported, and actually this comes from a prediction from Gartner, where I come from. They predict by the year 2025, so next year, they foresee that less than 50%, less than half of companies are going to be able to properly manage the number of APIs and the complexity of APIs, because they simply don't have the capability in place through their management tools to properly understand how these things are changing or need to be properly maintained. So you tie all this together, and if I were a CEO in a major corporation today, I would be extremely concerned about how I'm going to be able to grow my business in the way that I want, while all of this risk is lurking. So let's get into what digital risk is defined as, what it really is at its base, and what it means to you. And so here I have a pretty comprehensive definition, and I'll just kind of pick it apart a little bit and give you an idea of what it really means to address digital risk in its purest sense. So digital risk goes beyond just the core technology risk that you may find in a given asset and looks at how that technology is being used either within the business or in delivering products and services to customers. And it's really a blend of the virtual and physical realms coming together and impacting either technology from failures or disruptions in software, hardware, or new tech, cyber, understanding where the threats from external cyber attacks are coming from that lead to problematic data breaches, unauthorized access, and more, the next category generating huge amounts of operational risk in that malware, for example, ransomware is bringing organizations to their knees, really disrupting um, the full business operation in ways that were not even imagined, say, 5 years ago. And so you got those losses due to the inadequate processes, the people, the skills, the systems, due to either digital tech misuse or um, again malware being infiltrated within the organizations, and then ultimately rising to the level of strategic risk in that it's impacting that organization's ability to reach its goals and understanding how the performance of the organization both from a financial and non-financial perspective is impacted. And so this complex landscape of digital technology as it's being rolled out is just so complex and interconnected, and I would say hyper connected, if you will. It requires a different way to manage and view the risk landscape that is known as integrated risk management. And this is something that I've been working on for the better part of now close to a decade and a half in developing a new way to view risks in the same interconnected fashion that organizations are utilizing this digital technology. So integrated risk management really goes hand in hand with understanding digital risk, both at its core and how it permeates the business as a whole.
Let
And
me
so,
jump. Let me
oh,
jump in
sure.
just a little bit on that point. Let's go back to that slide for a second because that is I can't be from Risk Connect and not jump in and ask a question when you start talking about integrated risk management. They would just take my license away.
Yeah, go ahead.
Um, so um, let's tease that out a little bit. You had four areas of risk. You had technology, cyber, strategic risk, operational risk. So walk me through a scenario. Um, Somebody might push back and say, "Well, why can't we think about these things in siloed terms? We already have. We always have. Ransomware is ransomware. It's this thing off by itself. You know, we deal with it. We have insurance for it. Whatever." Um, Take me through exactly how these things are interconnected, right? What's a scenario where um, looking at risk in the internet connected way that you describe is important because these things, you know, correlate with each other, affect each other. Tell me about that.
Yeah, definitely. And I'll use a simple example that I think is probably relevant to everyone on the call, just to its great use today, and that's cloud computing. And cloud computing, I think, has really offered organizations better and more efficient ways to managing their technology assets. But at the same time, it has opened up so many avenues for organizations to um, become or really set them up for changes in their business processes to allow them to be more adaptive, to be more nimble in making sure that they are reaching their customers in new and helpful ways. And so when you think about cloud computing, you're removing that physical asset, whether be a server or some sort of hardware out of your data center into a third party's data center and being managed in virtual ways across hundreds, thousands of servers that really brings a whole new level of complexity to the management of just the technology risk and understanding where data resides, how it's being secured, whether it is truly meeting the you know number of regulations from a privacy perspective across the various jurisdictions around the globe. So, that's just like the base concern that a lot of organizations have, but they typically don't go beyond that in thinking how risk can then permeate the organization, come back onto the organization through a potential scenario, whether it's a data breach within the cloud provider, or if it's a third party that that cloud provider may be using, where a data breach is originated or a set of malware is originated and proliferates through the cloud and into um, that business's own data set, and then what happens from there. So you've got that element into the operations of the organization. And then ultimately, strategically, more and more companies are having to consider what sorts of data are being housed within the cloud, whether or not they're being managed in the way that fits in with their risk appetite. And if it's a area, maybe it's a new product or service that is critical to the organization's either growth plans or survival going forward from a competitive standpoint, are they willing to place that bet with a given cloud provider?
Sure.
And then you think about concentration risk, making sure that you don't have all your eggs in one basket. So what I think this is all doing, bottom line, it's taking that technology risk and now it's extending it into the full realm of business risk for
Mhm.
organizations.
I see. Thank you very much. Please continue.
And I think that's actually a good setup for this slide and how organizations can begin to think differently about digital risk for sure, but just their whole business. And not only from a technology or cyber risk perspective, but also from the core operations all the way through to the strategic and enterprise risk. So, as you can see here, integrated risk management attempts to tie those areas of risk horizontally across the organization, bridging the gaps between typical siloed risk management domains, and looks to provide not only a view of how that risk can be better understood and directed through policies and procedures, or in other words, simply controls to mitigate the risk levels within the organization, but also how those controls, policies, and procedures fit into the delivery of products and services at the top
Mhm.
here. And those are really, I think, the key elements of integrated risk management. But when you start to bring these things together, it layers on a whole new way of thinking about risk for risk professionals, security professionals, compliance professionals, insurance professionals that they may not have considered before. And it hinges on four key risk objectives, starting with the first here, performance. And this objective with the other three that I'll mention here in a moment, they are objectives that every single organization, no matter size, industry, or location around the globe, has to solve for and has to solve for in a successful way. And beginning with performance, it's not only financial performance, but more and more non-financial performance. How organizations can operate in safer or more sustainable ways in thinking about the products and services they're delivering. And it's typically aligned with the risk domain of operational risk management and looking at the business operation and whether or not it's meeting those performance levels. And more of those performance levels are being reported to key stakeholders like investors or regulators through the likes of sustainability reports, for example. So it's becoming ever more important because of the transparency needs to understand the risks associated in that realm. At the same time, we've been talking about the resilience challenges that organizations are facing, certainly through technology being not only a great risk driver in testing organizations' ability to respond and recover to a given risk event, but also a great enabler of managing the risk levels. And so we typically see this very much aligned with the realm of IT risk management in many organizations. And then we also have the level of assurance that is required, certainly in highly regulated industries, but more and more just in every single industry, needing to prove to a number of different stakeholders that the organization is really focused on the right risks, number one, the relevant risks to the organization, and that they are addressing those risks in the right way. And this is being driven primarily through the likes of enterprise risk management programs and certainly serving the needs of the senior leadership and boards of directors and reporting out to other interested parties. And then finally, you've got the area of compliance. And this area is changing as well, in that the focus is shifting to areas of non-compliance, whereas in the past it was just simply about getting the compliance requirements right, making sure that you're doing the right things. But now more and more regulation is becoming time-based, and time-based meaning that organizations have to do a better job of rooting out the areas of non-compliance and then disclosing that within a given time window. And most of this activity is related to GRC programs that we see within organizations and being able to quickly respond or assess and respond to those areas of non-compliance. And a great example is what we're seeing, you know, today with the rollout of the new SEC cyber risk disclosure rules. When a cyber event of any type is experienced by an organization, if it's material, it has to be reported within 4 business days of determining that they've experienced that material cyber event. So you've got to be very quick in doing this. And you have to bring together a whole set of different leaders throughout the organization. You certainly have on the strategic and enterprise risk side, the CEO, board of directors, chief legal officer involved. But then you've got to couple that with greater involvement from the technology and cyber risk realm from the CIO or the chief technology officer, chief information security officer, also the chief HR officer as it relates to how people are using technology or not using it appropriately. From the products and services perspective, more and more you're drawing in the what I call the CDO or the Chief Digital or Data Officer, who is driving these new digital product and service development, but then partnering with the likes of the CFO and the Chief Operating Officer. And then finally supported from a policies and procedures perspective by the chief compliance officer, chief risk officer, as well as the chief audit executive.
Let me just ask you a quick question. Since we're talking about an integrated risk management model here,
Yep.
does insurable risk have a seat at this table as well as all obviously non-insurable risk?
Yeah, that's a really good point. And what I would tell you is most definitely they they do have a seat at the table. Through this lens, I'd say that most often it is tied through the chief risk officer from an insurable risk perspective. And the reason is, I view insurable risk as more of a way of managing the risk. So when you think about the four ways that you can go about managing risk, you can either accept the risk right out with no further activity. You can reject the risk, so avoid that activity altogether. You can mitigate the risk through, again, policies, procedures, controls. And then finally, you can transfer that risk. And that's where insurable risk comes into play. And so, how do you go about transferring that risk in a way that meets the overall risk appetite of the organization? And one great example here, as it relates to digital, is certainly cyber insurance. And cyber insurance is something that I covered for many years at Gartner and had the opportunity to review literally probably more than 1,000 individual policies in helping clients figure out whether their policy was truly of value. And so when you're looking to transfer the cyber risk, as the insurance folks on the call are certainly going to understand, it's all about making sure you understand where the exclusions within those policies lie. And what I found in reviewing well over 1,000 policies, that in most cyber insurance policies, the exclusions outweigh a lot of the true value to these policies. And the fact is, it's because of the lack of actuarial data that exists to truly and effectively underwrite these policies.
Mhm.
And so, what insurers have been doing is really relying on information provided by the company on their security practices and using that to underwrite these policies on a case by case basis. And so, as organizations are looking to transfer the risk, and the insurers are being very conservative in underwriting these policies, it's incumbent on the organization to understand whether or not they're transferring the risk that they intended to. So
Sure.
you gotta look under the hood there and make sure that it's really the policy that is needed. At the same time, I will tell you these cyber insurance policies do offer some value, I would say, to organizations at the smaller and mid-size um, tiers because they provide some additional services that can help organizations be more resilient in responding to these cyber events because of course the insurers want to manage the level of loss associated with a data breach or what have you.
Yep. Small digression. One of the reasons that I bring this up, when Risk Connect thinks about IRM, they typically think about all forms of risk being centralized and being a technology company. There's a centralization of data. There's a centralization of documentation and connectivity within those things. And one
Yes.
of the things that we've found there's some interesting things that happen when you do that. One of the things that we're talking about right now is the idea of true transference. Exactly what you just said. What exactly has transferred, and how transparent is that, and can you see it, and how does that relate to other policies and fill holes and stuff like that?
Yes.
The other one that's interesting is actually thinking about insurable risks as indicators of other risks, right?
Yes.
So the idea is, are there clusters of claims
Mhm.
that fill up? Now, in technology and cyber breach risk, you have one breach every so often, and it's a major pervasive thing, and so you normally don't think about that particular risk as a cluster. But in general, if you have claims clustering around a certain vendor, right, that might pose an underlying risk, and that gets you down into your third party risk, or that gets you down into compliance, just like on your model and so forth.
Yep.
So there are probably a couple of interesting ways to think about not just ERM GRC, which a lot of people are used to thinking about as one thing, but bringing in health and safety, insurable risk, and all of these other things kind of pervasively, in terms of the benefits that you get from centralizing all that data and being able to look up one thing based on another and so forth, as I know you're aware.
Yeah. And I would agree. I think that's a huge opportunity with REMIS
Mhm.
technology, and the claims management piece, and in particular in the cyber realm, because as more and more companies are looking to quantify the risk associated with cyber, they need a lot more information, a lot more data points on the losses that are occurring
Right.
within their organization associated with cyber. So not only are
Yeah.
insurance providers at a disadvantage now because they lack the data, it's also the same for organizations themselves. So not this data source of claims can be used to better predict where these risks may emanate, as you rightly said, in terms of indicating not where the risk may emanate from, but also the level of risk that can be potentially experienced
Yeah.
over time, and allow for more strategic kind of views of whether or not a given activity, area of investment is truly worthwhile. And right now, the data is very, very limited.
That's very interesting.
So, so with that said, we need more data, we need more visibility, we need more understanding, and we certainly need that in areas where things are rapidly changing. And when I was at Gartner, one of the primary areas of research and reports that I worked on was something that we called the hype cycle report. And I'm sure there are folks on the call that have seen these hype cycle reports before if they've ever worked with Gartner. For those of you who have not, let me give you a quick primer on what this is all about and why I'm talking about it today. And I think one of the best hype cycle reports from a digital perspective to consider is the hype cycle for artificial intelligence, given its dynamic nature and its impact to not only business organizations, but even our personal lives today. And what you see here is a graphic representing all the different AI related technologies as they progress through the various levels of marketing hype that most, if not all, technologies go through. And so this is used by Gartner to help their end user clients better understand and prepare for when they might want to adopt a given technology. And so, given that this is in AI and is focused primarily on emerging technologies, you'll see a whole host of different technology dots, if you will, in the first stage being the innovation trigger when these things first come to market. And quickly, if you look at the X and Y axis here, you'll see that the level of expectation on an end user's part rises very rapidly, and it's driven primarily through really good marketers and helping end users start to think about how these different technologies can be used to their advantage. And so that hype builds quickly to a level that is known as the peak of inflated expectations. And it's where one of the primary AI technologies that I want to use as an example, it rests today at the very peak of inflated expectations. That's generative AI. And I'm sure no one would disagree, given the amount of focus on the likes of ChatGPT and other generative AI tools. What we find and what Gartner has found over well over 30 years in their experience is that once that technology reaches peak hype, it will quickly fall into what's known as the trough of disillusionment when those expectations are dashed and end users end up realizing that a lot of that hype truly was pure hype. And the technology itself may not address the real world scenarios that it was designed to meet. The best example here is the use of autonomous vehicles and what's been happening with them, especially in the last 6 months or so. As most of you have seen in the press, a lot of these autonomous vehicles, when they are experiencing various real world scenarios, are not operating as they were intended. And the best example I can give is the example of the Cruise driverless taxi in San Francisco, that when encountering a pedestrian on the road, it actually ran into the pedestrian. And as a control within the car itself, because it hit something in its field of travel, it was designed to pull over to the side for a safety measure. However, it was not designed to understand when that incident occurred, whether or not pulling over to the side was the truly safest alternative. And when it hit the pedestrian, it pulled to the side with the pedestrian dragged underneath the car. And so that led to a wholesale change by GM and pulling those cars off the market. And that is like the probably best example of what we see in the trough of disillusionment. Things occur in a different way, and the organization has to retrench. So we see autonomous vehicles starting to climb up what's known as the slope of enlightenment. And this is when a technology is enhanced to fully anticipate and operate within the real world. And we see here as it progresses into what's known as the plateau of productivity, the final stage of the hype cycle, this is where we see great adoption across the end user community. And Gartner would say greater than 50% adoption by the time a technology reaches its plateau of productivity. One other thing just to note out here across the hype cycle is that these various technologies progress at different rates. And you'll see at the bottom here, it spans from less than 2 years through the full cycle, all the way up to greater than 10 years, very slowly moving technology. And there are also times when something will not make it through the hype cycle. It will be obsolete before it gets to that plateau. So why am I talking about this? Well, in my time at Gartner, when I was generating these hype cycle reports, like the hype cycle for artificial intelligence, given my risk, passion, and focus of research, I always wondered and thought there was something missing from this hype cycle. And it truly was, how are the risks being anticipated as the various technologies progress? Well, since I've left Gartner, I have put together what's known as the digital risk cycle that is inspired by the hype cycle, but I think can be best used by risk leaders, professionals, whether you're in security, insurance, compliance, audit, to better anticipate how risks are going to emerge over time, and at the same time, how you might be able to take advantage of that knowledge and prepare in advance for that risk. And so, as we look across a similar cycle, and I will tell you what I'm presenting here is a cycle of technology progression without any sort of risk management applied. What you'll find is when we look at the likes of generative AI being again at that peak of inflated expectations, or autonomous vehicles being at that low trough of disillusionment, that these things require a whole new view of risk. And it all begins with, similar to the innovation trigger, understanding what is the catalyst for this new type of risk that is associated, in this case, through digital. And when that risk is identified, typically, when you think about generative AI as an example, you'll think about individual elements of risk, such that there certainly is a lot of risk to the data that is being either used or generated by AI, whether or not it is reliable, trustworthy, whether it's been impacted by any unauthorized access. All of these individual risks contributing to what I've labeled as the pinnacle of perils. So this list of perils quickly starts to add up as the technology reaches that pinnacle. And you've got this whole slate of risks that certainly need to be addressed, but they need to be addressed in a way that is relevant to how that product or service or new process is being used. And typically, it's not addressed in that way. All these risks are mitigated on a one-off basis, and scenarios will quickly emerge that drives the technology into the what I call the pit of empty promises. So again, autonomous vehicles being a classic example of where all sorts of risks were identified and being managed very well through the use of this driverless taxi in San Francisco. But when you start to think about the various scenarios that it could encounter, a lot of times things are left out. And it leads to unintended consequences like dragging a pedestrian to the side of the road. And so that requires a whole new way of thinking that is much more scenario based and much more integrated in view. And it requires this slow, what I call incline of integration into how that product or service can be integrated into its true use case or usage in the real world. And then finally, reaching what I view as kind of the opposite of the pinnacle of peril is the mesa of mitigation. So reaching that stable environment where it's operating at a high level, but within a given risk appetite that makes sense for the organization. Now, as I said in the beginning, the initial cycle is driven by a lack of really mature risk management. But if you start to employ integrated risk management view, approach, and even technology set, you can find what I call the optimal digital risk path by anticipating the various events that accompany each of these stages. You can certainly lower that pinnacle of peril by quickly understanding the scenarios and incorporating that into the design of a product or a service, and then better manage the increase in risk so that you don't have that volatility through the pit of empty promises on your way to the mesa of mitigation. So there are some key steps to be able to follow that optimal digital risk path, and they're associated with each stage of the digital risk cycle. And these steps are going to be very familiar to those of you who are risk managers because it's simply following a typical mature risk management approach, but in a way that allows for companies, organizations to better prepare. So in the risk catalyst stage, again, once you identify that this new technology may be coming to bear within your organization, that's when you really need to start to adopt the scenario focus. How is it going to be used by the organization? And begin that initial assessment and monitoring. So going beyond just identifying the individual risks. And then when you reach the pinnacle apparel stage, hopefully you're already in that evaluation activity of engaging the stakeholders who are going to be involved in rolling out these new products and services and conducting more formal assessments so that they know their role in the management of the risk, and then developing response strategies and enhancing controls around that scenario so everyone knows what to do when a given scenario presents itself. And that's when the risks start to be realized, much like the autonomous vehicle. And those scenarios need to drive appropriate risk responses, and also having in place the ability to monitor the impact of those responses. So, in the case of the driverless taxi, being able to have that taxi have the proper controls in place so that it would avoid dragging the pedestrian. But even in that case, being able to respond to a given scenario, maybe it's an unintended scenario, in a very rapid way, and then adapting the controls and changing that product or having the product changed in a way that can be effectively implemented rather than having to pull the product off the market. And then once that full on realization of scenarios, risk scenarios comes to bear, it's all about making sure that they're integrated back into the business operation and understanding how this can be maintained over the long term. And it's typically at this stage also when laws, regulations start to kick in, because as we all know, laws and regulations are typically a reaction to given events in the real world. This is where it kicks in. You need to make sure that those scenarios anticipate those regulatory challenges. And then finally, when you get to that mesa of mitigation, if you will, it's all about how you can be more efficient in the stable risk environment by employing continuous control monitoring, especially in the digital risk realm, that allows for more automated assessments, and making sure that as the product, the service, the process changes over time, that it remains within the appropriate risk appetite alignment. So, if you follow those steps along the path, you're going to be in a great position with your customer base. And this is where I think the rubber really meets the road, and where organizations are going to be challenged throughout the rest of this decade. And what I'll tell you is consumers are smart, and they already recognize this growing digital risk. And this is where competitiveness is going to be key. Those organizations that have a really tight understanding and visibility of their digital risk landscape are going to be the winners. And the reason why is, and this comes from a survey from Deloitte, by the way, their global digital risk survey that was conducted last year. They're going to be able to provide the transparency that consumers are looking for. And in that survey, Deloitte found that 60% currently don't feel adequately informed by the organizations about how these digital technologies are being utilized. And so that leads directly to trust. If the consumer is not trustworthy of that product or service, they're not going to buy it. They also realize that many organizations are going to have to be held to account by outside sources through regulations. And they agree, more than half agree, that increased regulatory oversight is needed. and it is coming. And I will tell you, one great example is the AI Act in the EU. It was just approved at the end of last year by the European Commission to move forward for parliamentary action and enactment. And I would anticipate the AI Act in the EU being fully enforced by the end of 2025. And we see, as a matter of course, a lot of this technology regulation starting out in the EU and flowing over to the US. And the best example there, a great regulatory push made by the EU was GDPR, the Data Protection Act that they had that has now driven a lot of change here in the US. Finally, the consumers have grave concerns about the ethics behind the promotion of these new products and services. And 60%, so very similar to transparency, 60% of those consumers don't think organizations follow digitally ethical practices. So, what does that mean? Well, I know a lot of consumers are very concerned about how their data is being used, how it's being sold, how these maybe AI algorithms are making decisions about whether or not a consumer can gain, say, credit or be able to use a given service. A lot of that in internal bias is being built into algorithms that may not be ethically um, suitable for that consumer or set of consumers within a given environment. So these are the areas that really matter as it relates to digital risk and how organizations need to be prepared. And it really drives the action plan for the organization. What I've laid out here in three areas are key actions that you can use when you go back to your organization in the immediate term. So, as soon as this call is over, what do you need to be thinking about doing next week into the next quarter? Short term, looking 6 months and beyond, and then long term, you know, I would say within the next 2 to 5 years through the end of the decade, what needs to be your focus? So, on the immediate standpoint, it's all about transparency and ethics because it's the consumer, you've got to gain their trust right out of the gate. And if you lose that trust, it's going to be very hard to rein it back in. Short term, you're going to see a lot more regulation coming to bear, as I mentioned before. And that's going to create a lot of new challenges. At the same time, you're going to see many more emerging technologies in the digital sphere come out with a need to better understand how they're going to progress through the digital risk cycle and what you need in terms of a risk management infrastructure to be prepared to deal with those new technologies. And then longer term, you've got to be in a position to integrate risk management all the way through the business and ensuring that it also meets these new level of regulatory requirements and at the same time provides for a very flexible, nimble way to address new risks or even new regulations through greater change in a very adaptive way. And by not only identifying those risks through the use of technology, but using technology to your advantage to be able to address those risks in a very quick and effective way. So, with that, I'm going to turn it back over to Scott and maybe we can go through a few more questions.
Well, thank you so much, John. Unfortunately, we are at the end of our time. But this has been incredible information. Very powerful model. 10 out of 10, by the way, on coming up with memorable names for the steps of the model. I don't think anybody's going to forget that anytime soon. John, I want to thank you for joining us here at Risk at Work and becoming a contributor. It's wonderful to have you here. I've learned a lot, and I know that everybody is going to continue to learn a lot from you over the course of your tenure with us. So I really appreciate that. I appreciate everybody who has joined us today on our call, on our web session, and we will see you for the next installment of Risk at Work. Take care.